Well, welcome to the More Than Money podcast, where we are passionate about changing our finances so that we can be a part of changing eternity. And that is our not so secret agenda here on the More Than Money podcast. We want you to get out of debt. We want you to crush that generosity killer called debt. We want you to save for the future. We want you to have enough money in your 529 plan so that you can cover some college expenses. College is very expensive now. We want you to have a great budget. We want you to be financially healthy. We want you to do all of those things to get there. And we're going to talk about those things. But those are not the end. They're just a means to a much greater end, because we want to see you in a place where you are financially healthy and are able to say yes more instead of not yet when it comes to living and giving generously. And we know you want that too. So welcome to More Than Money. We are glad to have you. My name is Art Rayner, by the way. I'm the co-host of More Than Money. Taylor, you're also the co-host of More Than Money. So welcome to the podcast.
Hey, I never even thought about that, but yeah, it's good to be back again.
He's also the producer. He's also the my friend. He's also a Texan. And we forgive that part of him.
Oh my goodness.
We overlooked that.
Didn't really have a choice in that one.
I'm glad to have you on the podcast here.
Well,
this
episode's
verse comes from Proverbs 11:14. It says, "Where there is no guidance, a people falls, but in an abundance of counselors, there is safety." Man, I got to tell you, there's so much wisdom there to have a group of counselors, a group of people that you can trust. That whether it's with financial advice, career advice. Hey, when I was looking at stepping away from my role at Southeastern Seminary and jumping into what I'm doing now, Christian Money Solutions, I reached out to my group of counselors. I wanted to hear from them, my friends, pastors. I wanted to hear from them and what they thought about the decision. And they were really the ones that encouraged me to take this jump. And I'm so thankful for it. And so make sure you have that group of men and women that can speak into your life, especially when you're making a big decision. Hey, so speaking of counselors, I'm a part of a financial group, not More Than Money. I'm a part of that, but another financial group. And as you probably know, there's a lot of concern around banks right now, and are deposits safe, and what happened with Silicon Valley Bank. And so there's a question that popped up on this particular group's feed. A lady asked, "Anyone else feeling concerned about the banks? I'm not seeing a huge amount in this community, but my husband is seeing lots of TikToks about preparing for bank failure. What is everybody's plan/preparations?" Now, look, just so you know, we've had some questions within our Facebook group, and I've had some questions, texts that I've received, direct messages that I've received about what's going on. And so in this episode, we're going to talk about what happened. Should you or should you not be concerned? And then how do you protect your deposits at your bank? It's going to be a great episode. We're glad that you're here. Happy Monday, by the way, Taylor.
Hey, happy Monday. I'm loving the week so far, and yeah, it's good to be looking forward to knowing what we're doing is serving the people. So yeah, it's always a good Monday with you.
So we just got through our first weekend of March Madness, and we're having a More Than Money bracket challenge. So the winner will have $250 donated to their charity of choice. I love the different charities that are represented in this group. And man, I guess it's a good thing, but I will definitely not win my own bracket challenge. I will not win the More Than Money bracket challenge. The first day was awful for me. So I had Arizona in the Final Four, and yeah, they did not win. And so it's going to be a rough ride for me, but that's okay. That's okay. Once again, it's probably best that I don't win my own bracket challenge. How are you doing?
My bracket is busted as well. I chose Virginia to be in the Final Four, and I
No.
was surprised within 2 hours of the start of the bracket.
You should never go with Virginia to the Final Four. I know they won it once, but man, they
What it
struggle in
was,
the
I
tournament.
felt good about it. And honestly, I have no idea what I'm doing when it comes to college basketball. I said this in the More Than Money group. I was like, I have a lot of superficial confidence about this right now. It's like I have no idea what I'm doing, but I feel like I'm going to win it all. I even named my group the one who rules them all. In
Ooh,
reference to the Lord of the Rings.
yeah, you shouldn't do
And
that.
yeah, it's embarrassing.
God will humble you if you
Yeah.
do that.
Oh
Yeah.
yeah, he already has, and he's going to continue. Yeah, I'm feeling that right now.
Oh man. Well, I saw a question, as I mentioned earlier, that was asking about this the Silicon Valley bank failure that happened. And once again, the question is anyone feeling concerned? She wasn't seeing a ton of information about it in this particular financial group that I'm a part of. But she goes on to say, but my husband is seeing lots of TikToks about preparing for bank failure. So I want to address that particular question. I've already sent out a few tweets about it, just letting everybody know where I kind of stand on it. Just so you know, I'm not overly concerned about it, but I wanted to walk our listeners through just some, I don't know, takeaways that you can have during this time. Starting with, be very careful with where you get your information. Be
Yes.
very, very
Yes.
careful. The one thing that immediately stood out to me with her question was, my husband is seeing lots of TikToks. TikTok is notorious for bad financial information. You
Yes.
have to be very, very careful with the financial information that you consume from TikTok. There was one video where a guy was being interviewed, and he was a financial guy, supposedly, or at least making himself out to be a financial guru type guy. And the lady was interviewing and said, so would you rather have $3 million? No, I'm $2 million right now, receive $4,000 per month for the rest of your life, or have an 850 credit score? What would you rather have? And he, in all seriousness, says, I want that 850 credit score. Wow. And she goes, why? He goes, because you think about it. I can, with an 850 credit score, I can take out as many credit cards as I want to. I can go well beyond $2 million and get way more money than $2 million, because I can apply to all the credit cards. I can do it all at once too, so that I don't get hit with a bunch of inquiries. He actually said that. And I can have more money than the $2 million. I promise. It's a serious video. It's completely serious.
I mean,
not thinking that, you know what, there's a difference between $2 million cash and $2+ million in credit card debt. Like that, there's a big difference between those two.
Way more than $2 million at that point.
I mean, what do you, but that's the type of financial advice that you can get on TikTok. Yes. So be very, very careful where you get your financial advice. You know that group of counselors that I was talking about? You need those. You certainly need some, like, us, but also friends, family members, those that are closest to you. Make sure you have that group of counselors surround you so that you can make wise decisions, maybe calm you down as well when you're feeling, anxious about something that you might not should be anxious about.
Sorry, I'm going to cut that gap. Yeah, I would definitely say with TikTok, it's not that there's people that aren't respectable on there. We know people who are on TikTok that have great financial advice. It's just, because there's so many voices on there that are just ill-experienced in this realm. I would even classify a lot of this advice as financial malpractice, because they're giving you really specific investment advice, which if you go into the normal world, this actually would be illegal. Because there's not any sort of certification behind their name. And so, yeah, just definitely, if you're going to follow any advice on TikTok, just make sure that it's an established voice that has been trusted for years. And that's going to keep you safe during this time, because TikTok, like Art said, just notorious for bad financial advice. We even know other people who are in the Christian financial realm who actually do videos that critique the TikToks. And it's just amazing what these commentators are missing the point. So yeah, just follow people that are established and you will be safe there.
So that's the first takeaway we want to give you. The second is this: bank failures are very, very rare. It's not that they don't happen, but they're rare. So from 2001 to 2023, there have been 563 bank failures. Now, that may seem like a lot until you recognize how many banks are out there. So the height of bank failures occurred, and this won't surprise our listeners, occurred after 2008. So in 2008, we had 25. In 2009, we had 140. And in 2010, we had 157. That was the height of the bank failures in our generation. Now, you could go back to the Great Depression where there were many more. But things have changed in a dramatic way since the Great Depression. We are in a dramatically different place than what happened then, especially with the different regulations and requirements that banks have now. We are not there, and so I'm not concerned like we're going to have this massive bank failure like we did in the Great Depression. Could more banks fail? Yeah, it could. But once again, it's a relatively small amount. So there's over 4,200 FDIC insured banks in the United States. So if eight failed, which over the past 5 or so years we've had some bank fails. So if 8 failed, then that would be 0.2% of a percent. In fact, from 2015 to 2022, just so you know, never more than 8 in a year have failed. In 3 of those years, we actually had 0. So we're talking about 0.2% of the banks. In 2008, when you look at that big number, it was around, and excuse my math, it's not going to be perfect. It's around like 3% of banks failed in that moment. But once again, we are in a dramatically different place in the Great Depression, and even 2008. There was a lot learned during 2008. The subprime market had a lot to do with that, and we are just not there. So what we saw happen with Silicon Valley Bank and even Signature Bank were relatively unique. It was relatively unique and very rare. I want to talk about what happened with Silicon Valley Bank, and then I want to talk about how our listeners, how you all can protect yourself by knowing about FDIC, what it is, and how to determine how much of your assets are protected, how much of it are exposed at this point. But first, I want to talk about a program that I'm really, really excited about. So we're going to talk about that, and then we're going to jump back into this conversation. Here's the reality. We need an army of certified Christian financial counselors to meet the need that's out there. Too many people are struggling with their finances and have no clue what step to take next, or that God has a lot to say about their money. So, are you passionate about helping others obtain financial health through a biblical worldview? If so, consider becoming a certified Christian financial counselor. Christian financial counselors help individuals and couples discover and pursue God's design for money. Christian financial counselors guide individuals and couples in making wise financial decisions, build sound financial habits, and increase their biblical and financial literacy. The CERT CFC program, so that stands for Certified Christian Financial Counselor Program, prepares you to take the CERT CFC examination. Now, here's what you will receive with the program: 32 go-at-your-own-pace modules covering the essentials in personal finances and what Scripture says about money, 32 practice quizzes, over 30 resources to help you with your future financial counseling, and of course, the opportunity to take the CERT CFC examination. Learn more by going to Christian Financial Health, that's with the th.com. Once again, that's christianfinancialhealth.com. Okay, so what happened with Silicon Valley Bank? We've talked about some takeaways. Number 1 was be careful where you get your information. Number 2, bank failures are rare. Here's really takeaway number 3. Silicon Valley Bank was probably different than your bank in probably a pretty dramatic way. To start the story, I want to make sure that you are aware, that the listeners are aware that banks, that they don't keep all of your cash on hand. Like, you could not go into your local branch and say, hey, I want all of my money. Now, let me be clear. You may be able to, but not everybody can do that at the same time. They don't have everybody's money at every branch all the time. That's not what they do. And just so you know, you don't want them to have all of your cash at that branch, because what the bank does when you give them a deposit, they take that money and then they use it for other purposes. What is that purpose? Well, they're making money. And that's a good thing. You want them to make money with your money because it allows you to keep your money at their bank for me, for free, right? I don't pay anything to have my money at that bank. Why? Because they're using my money to make money. That's where they're making their money. If they did not do that, they would have to charge us as consumers to be able to hold the money there. So it's a good thing that they're using the money for other purposes, to lend out to others, for mortgages. So there's no bank that has all of your money at a bank branch.
Right.
So you need to know that. So Silicon Valley Bank was unique. It had a very unique customer base. It was primarily startups. So a lot of venture capitalists were there, and tech companies. Now, 90% of their holdings, 90% of their holdings were not covered. I should say their depositors were over the $250 limit of the FDIC. So 90% of those were above that. They had so much money in this bank that they were not covered by the FDIC. Now, I believe it was March 8th, the bank announced that they needed to raise additional capital to cover a gap. Now, this particular bank had invested a lot of money in long-term government bonds. And that may seem like a good thing, right? It may seem like a pretty secure thing, but here's what happens when interest rates start to go up. The value of those particular bonds go down. And so as the Fed raised the rates, the value of the bonds went down. And so the bank put themselves in a lot more fragile position. People started getting concerned, started wanting to move money from the bank, and they were just not in the position to be able to give everybody their money. In fact, they end up selling those bonds at it's like a $1.8 billion loss, or some of them, to help cover the gap, which only raised more concerns about the bank's stability. And so now this isn't most banks, just so you know. The way that they had their money set up, it's more than likely it's not like your bank. So there's actually a quote by a Yale professor. He said, "This bank would seem to fit perfectly at home in the 1920s or the 1870s. Lots of deposits and a lot of local customers." Once again, we're talking about tech startups. We're talking about venture capitalists. The very biggest banks have much more diversified client bases and also somewhat more diversified funding sources. So it wouldn't be funded as much by deposits, and therefore it's prime for a run. So it was a different situation that the bank was facing, and your bank more than likely is not like SVB. It's not. So you can, once again, I'm not saying all banks are completely different than but the vast majority of banks do not operate like Silicon Valley Bank.
Yeah, it definitely sounds like their problem was their diversification of their assets and just how they invested that money. Just ended up slashing them in the face, landing them with egg on their face. And so I can imagine with most banks around the country, there's a little bit more of a diversification there. There's more immediate yields rather than long-term yields. There's also long-term yields. And so just keeping that in mind, this, like Art said, this is so rare. I know it's easy for us to look at the TV and then picture ourselves in that situation, but we're also going to tell you how you can find a lot of comfort whenever you are in a bank that is FDIC insured. But yeah, just so you know, this is not the norm, and we shouldn't act like it is.
Yeah, and now the government did step in and save this bank. Now that's another conversation. I'm not going to go down that road. I have my own opinions about bailing out banks when they get into these type of situations. So we're not going to go down that road. But if you're still nervous, just so you know, you can be confident in knowing how the FDIC works. Now, the FDIC was established to build customer confidence in banks. So the FDIC, they examine banks for financial soundness and consumer protection, and they also provide deposit insurance for customers of banks. And so the FDIC insures these types of cash accounts, checking accounts, savings accounts, money market accounts, certificates of deposit, so CDs, and prepaid cards. So what they don't insure, just so you know, are investments. So they basically insure cash. Now they cover up to $250,000, and here's what you need to know per depositor for each category per bank. So you got to know those three components: $250,000 per depositor for each category per bank. Now, according to the FDIC, categories include single accounts, joint accounts, corporations, partnerships, some retirement accounts, depending on what those investments are, unincorporated association accounts, and more. For most of us, it's that single and joint account category that matters. So let me give you an example of how this will work. So let's just say you have two savings accounts, and one saving account is single. It's a single owner, so it's just you, and the other is a joint account. So Taylor, maybe you have an account that's just in your name, and then you also have a savings account that's in your name and your wife's name. Which, by the way, I would encourage you to get that single account in both of y'all's names.
I know, what in the world is wrong with me?
Just for the example, let's say that's the scenario, and it's all at one bank. If that's the case, you are covered up to $250,000 for each account. So $250 for the single account, and then $250 for the joint account, because those are two separate categories, even at one bank. So you can be insured more than $250,000 at one bank, because once again, it's per depositor, per category, per bank. So let's now say you have two savings accounts, and both are, single at two separate banks. So you are then covered up to $250,000 for each account, right? Because they're two, even though you're single with both accounts, they're at two separate banks. And so you're covered with both of them. If, say, you had two savings accounts where both were single and at one bank, then you're covered up to $250,000 for, even though you have two different accounts, because they are the same category. They're the single ownership. And so that's how the FDIC works. And by the way, the FDIC actually offers a calculator so that you can estimate how much of your deposits are covered. And so I'd encourage you to go check that out. The reality is the vast majority of us are covered. I mean, the vast majority of us, assuming that we're at an FDIC insured bank, and you can go and look and make sure that your bank is covered by the FDIC, assuming that your bank is covered by the FDIC, the vast majority of us are going to be okay. If our bank, even if in the remote chance that our bank goes under, if it fails, then we're covered by the FDIC insurance.
Absolutely. And Art makes a great point when it comes to diversifying between accounts and between types of accounts. We actually discussed this to great detail in if you take the CERT CFC course, he covers this about how to make sure that you're maximally covered. And so, like in that situation where he talks about two savings account at the same bank, well, you might have $350,000 total at that bank. Well, because it's the same category, you might want to move $100,000 to another bank just so that you can have all that amount covered. And so this is all great advice, especially when it comes to FDIC insurance. We hear that on the commercial. If we hear a bank commercial on the TV, we don't really know what it means. This should give us a lot of assurance that when it comes to depositing money, or if we see these things on the stories, and once again, when we look at the media, I'm not I'm not conspiracy when it comes to this. We all know that media like to focus on bad news. They just
Yep.
do. It sells more, it gets more clicks. And so this sensationalizes the issue and makes it bigger than it really is. And so I just want to encourage you that in most cases, in majority banks, and I would encourage you also to look at your bank, see if it is FDIC insured, and if it's not, make a decision on whether or not you should move your money to a bank that is. And so yeah, just be encouraged by that. Most banks, I would say, are going to be in that category, but make sure you check.
Yeah, the right story is, first of all, bank failures are rare. Second of all, this particular bank was in a very rare situation. So bank failures are rare in general. Then, this bank was in a very rare situation. And the reality is most of us are not going to find ourselves in a place where, one, our bank fails, and then two, assuming that we have our funds diversified among banks and that they're fully covered by the FDIC, there's really not much to worry about. So I'm not, and I know it's not going to sell, a lot of clicks, a lot of downloads, because I'm not going with that extreme view that everything's gonna fall apart.
Right.
I can't go down that road, because I don't think that's the truth. So I'm just going to say I'm calm about it. I'm okay with it. I think you should be too. Double check with the FDIC coverage just to make sure that you're good there. But those are my thoughts on this bank, or on this bank, the bank failures, and what I think we'll ultimately see in the future. So we're not going into any money questions this time around, but we do want you to send us your question. If you have a question, you can go to christianmoneysolutions.com, click on the contact tab, fill out the form, get us a question that way, or you can leave us a voicemail at 984-235-2855. If we use your voicemail on the podcast, coffee is on us. We'll send you a $5 Starbucks gift card. Well, at the end of every episode, we like to leave our listeners with a money challenge. And so here is this episode's money challenge. Go check out your FDIC coverage. Use the FDIC estimator to see how much of your deposits are insured. This quick move can help bring about some peace of mind, and it is a great stewardship move. So make sure that you are fully insured by the FDIC. So that's your money challenge for this episode. All right, it is time to wrap up. Taylor, thank you so much for joining us. It's always fun.
Man, it's always a pleasure, man. It's always fun.
Be sure to give us a rating and review. It helps us get the word out about More Than Money. You can do that on Apple Podcasts. It takes like 15, 20 seconds to get done. Let's be the generation that's passionate about changing our finances so that we can be a part of changing eternity. Let's give generously, save wisely, and live appropriately. Until next time.